We have a fantastic panel with two papers. The plenary panel here. The first paper is on the Puerto Rican situation. The paper is authored by Bob Chirinko, a very distinguished economist at the University of Illinois at Chicago, and we have Brad Setzer, who is the world leading expert in bailouts, to discuss the paper. So with that introduction, I want to pass it over to Bob to take it away.
Thank you. Thank you, Dan, and thanks to the organizers for allowing me to participate in this conference, which has been very, very, very interesting, and for, of course, the opportunity to present this paper with my co-authors, Ryan Chiao, Shana Henderson, who are two undergraduates at the University of Illinois at Chicago. Now, what we're interested in here, and I think what we all know, is that Puerto Rico is in financial distress and, of course, has filed what is effective bankruptcy. We're not interested so much in that issue per se as to what went wrong there. In some ways, that's kind of easy. Expenditures exceeded revenues for many years, and they were unable to pay their bills. The question that motivates us in terms of what went wrong is, why did financial markets and why did financial investors continue to allow capital to flow to Puerto Rico on relatively very, very favorable terms? And that's the issue that we want to focus on in this paper and try to understand it and also the policy implications that go with it. Okay? So we looked at some data initially and very casually and just sort of said the yields just didn't seem to be high enough to reflect the kind of economic situation that we saw in Puerto Rico. And this quote from Barron sort of encapsulates exactly the sort of view that we had, that the numbers just didn't seem right. And hence we started this investigation to try to look at things a little more a little more carefully. Let me just give you one example of that. In April 3rd of 2012, there was an offering of bonds in Puerto Rico, one uninsured bond and one insured bond. You see the dollar figures there for the exact same maturity. When you use those data, and we'll talk more about how we compute risk premium in a couple minutes, you see that the risk premium implied by this was 146 basis points. High, low? Well, let's compare that to AAA and BAA types of rates in the next slide. And you see that on that day, April 3rd, 2012, basically it was sandwiched between the corporate AA rates, very high quality paper, and basically BA rates, which are not obviously the same credit quality, but still quite high. And so the puzzle we have is, why was that risk premium not higher here? Why was it just so low? Risk premium is absolutely key in financial markets for allocating capital. And what went wrong here, to our way of thinking, is why did financial markets fail to allocate capital accordingly? The answer is the Treasury put, by which we mean basically a bailout by the Treasury. To use options language, investors viewed that they had to put the right to place their bonds with the Treasury in the case of default. And what we want to do in this paper is examine that to some extent. Okay. As you know, I think especially in this audience, January 4th, 2016, basically Puerto Rico defaulted on some debt commitments, and then later in June of that year effectively went into bankruptcy. And of course we understand why it's effective, since territories can't really go into bankruptcy. But there's a PROMESA to sort of ease that along. All right. What we're going to do in this paper is just again ask, why were investors so myopic or misinformed? Or was it that they weren't misinformed and they really thought they had the backing of the Treasury? And we attempt to identify and quantify the latter, the so-called Treasury put. And there's three sort of research windfalls in this that kind of went from just sort of a curiosity. And being a resident of the state of Illinois, we're kind of interested in bankruptcy and state issues. Being an employee of the state of Illinois, perhaps even more so. And so it was just kind of a curiosity, frankly, that got us interested in this. And there were three things that fell into place that made this kind of an interesting paper. The first is, of course, that Puerto Rico is in dire financial straits, and therefore becomes much more useful and interesting to study the possibility of a Treasury put. If it's going to be anywhere, it's going to be in Puerto Rico. Second is the simultaneous issuance of debt securities that are both insured and uninsured that we can match up. And it makes estimating risk premia, which is the key part of this paper, relatively easy. Finance has all kinds of models for estimating risk premia, but they depend on sets of assumptions and sets of conditions which might not hold. We can do it kind of simply here. And the third, importantly, was a seismic shock that extinguished, at least temporarily, the Treasury put. And we can then see what was going to happen as a result. So we were lucky, and the fact that we had all these additional pieces then led us to continue working on this paper. And so the outline of today's talk is fivefold. One, we're going to argue that macro fundamentals were dismal, default risk was too low relative to those fundamentals, the Treasury put was alive, that ultimately it was extinguished, and then the default risk rises consistent with the Treasury put type of interpretation of the data. Okay, dismal effects. We could look at several. The paper has several charts. This one basically goes from 2000 to 2013 when we had data on real GDP, and you see what's happening. Basically, it peaks at about 2005, and since then it's been basically declining. Okay, kind of bad news for sure. A factoid, which many people may know, is that all Puerto Ricans are U.S. citizens, and they can travel to the United States and work immediately. This is really good news if you're a Puerto Rican national, but this is really bad news from an economic point of view. Okay, and so, well, not surprisingly, population growth drops, and this is growth rates now on the vertical axis. And so in the most recent year that we had data in 2016, 2% of the population left. Making no adjustment for quality here, but you know who's leaving. It's the young people, people with some set of skills that's going to be marketable in the United States. Again, horribly bad news for Puerto Rico. Not surprisingly, the public liabilities to GDP have been rising. From 2000, they were basically numbers like about 65, 70%, been going up steadily to numbers over 100%. These numbers are always a little bit funny because you got pension liabilities involved in here. How you value pension liabilities is a tricky matter, as several sessions at this conference have indicated. But the numbers are kind of dismal. Now, I presented this slide in this talk generally at a university, and I put up this slide, and a person put his hand up and said, "What's wrong with 100%?" You know, and I actually, and as an aside, he happened to be an Italian economist. You can understand why, but frankly, I didn't have an answer to him, because what is wrong with 100%? And there's some interesting parts of Puerto Rico. The Puerto Rico citizens don't pay federal income tax, and hence they're not responsible for the federal debt. And so maybe, 100% isn't really all that uncommon, and you should think of them more like Italy and Japan than we should, Illinois. So Illinois' number here is 16%. And again, is relatively small, but as an Illinois resident, I'm responsible for the federal deficit. Puerto Ricans generally aren't. So it's not hard. But the positive part that came out is go look at the operating surplus, and we look at that again, it's kind of bleak. This is the government deficits as a percentage of nominal GDP from 2002 to 2014. And again, the number's going up. At the low point on the left-hand side of the diagram, it's 1%. It's going up to 6%. In 2014. So in 2012, for example, when those bonds were issued, the one that I had at the first early slide, government deficits, this is just operating deficits, not paying back debt. Operating deficits was 4% of GDP. Really bad news, it seems to me. Fiscal capacity of Puerto Rico is quite low. It's a relatively low income area. U.S. average GDP per person is $55,000. Our poorest state is Mississippi with 40,000. Puerto Rico is half of that. So the fiscal capacity just isn't very great there. And then lastly, coming back to the demographics, which again were quite dismal, Puerto Rico is relatively old. In 2015, the median age is 36 years. Comparing that to the Caribbean region, it's 6 years older than that. Relative to more developed and less developed countries, it's sandwiched in between those two. But the projections are really horrible. And in 2040, the projections indicate that Puerto Rico will be older than the United States, again, median age, well older than the Caribbean region, and well older than less developed countries, which tend to be younger. Okay. So the point of all these slides, and there's some additional ones in the paper, are macro fundamentals are dismal. Okay. Second point is default risk is too low. How are we going to compute default risk? Basically, we compare insured and uninsured bonds. There's a bit of algebra and so on in the paper. I don't want to spend our time going through the details, but let me suggest that we basically make some adjustments for tax-free income, maturity differences, liquidity premium. These points have been emphasized quite a lot in the conference here, and we're glad we adjust for them. Default risk by the insurer and shocks overall to the municipal market. So we make those kind of adjustments. Let me keep moving on a little quickly. We have data from 2000 to 2016. We focus only on general obligation bonds because I don't want to get into the situation about how we value certain revenue streams that are associated with paying back revenue bonds. So we just look at GOs, and we basically find 45 uninsured bonds that were issued from 2000 to the present, and we match them with basically insured bonds. Okay, and so we do a match that's very close, and they're issued on the same day, a very important point. Let me skip that point here. And basically, then we have 13 issue days for the 45 bonds. And basically, so we have 13 lines in this chart. And basically, the idea that we saw earlier, the Puerto Rican risk premia is sandwiched between the corporate AAA and BAA holds here. I'd call your attention to the last line here for the averages, the penultimate line. And you see the corporate AAA is about 1%. Puerto Rico is about 1.6% on average, and the BAA is 2%. Okay. There's one exception. It's in red there during the financial crisis when it pops out above the risk premium pops out. But generally speaking, the bond risk premium for Puerto Rico seems pretty low. So we argue that default risk was really too low given that information there. We argue then that the Treasury puts alive. Okay, only the people with some gray hair remember New York City. But in '75, New York City faced bankruptcy. The numbers here have been blown up to 2013, so everything's comparable. Importantly, the bailout was initially refused by President Ford, who was famously quoted in the New York Daily News, inaccurately, he claims, that President Ford to New York City says, drop dead. So it turns out, while the Republican administration was keen on not supporting New York, they nonetheless gave in ultimately and did offer a bailout there. Okay, that's one example of a bailout, but there's a whole host of them, right? And the list is here, and it's probably not even complete. Lockheed Chrysler, Savings and Loan, Brady bonds. I happened to sit next to a Mexican national last night at dinner, and we had a bit of an argument whether or not it was a bailout or it was a temporary loan to Mexico. But undoubtedly, it committed U.S. Treasury resources in a serious way. So what we want to call it is hard to know. TARP, of course, and importantly, at the bottom of the TARP is that GM and Chrysler were bailed out, and I'll come back to that point in just a second. I think there's something called the Geithner Doctrine, which is that no significant financial institution should be allowed to fail. Lehman Brothers, in some sense, is the exception which proves the rule, proves the importance of the Geithner Doctrine. The Euro crisis, we'll talk a little bit more about that toward the end of the presentation. Mario Draghi, the head of the ECB, basically made a famous speech where he basically said, and I quote, that he will do whatever it takes to basically make sure the euro is standing and that the financial difficulties of Greece and other countries were taken care of. All right. My favorite one is probably Northern Rock, a relatively smaller affair, where the Bank of England initially took a very firm stand on not bailing out Northern Rock, which had basically experienced a standard classic bank run. And the reasons were, the usual of moral hazard. The Bank of England reversed course in 24 hours. And the then Bank of England governor, Mervyn King, became known as Swervin' Mervyn for his reversal on this situation. But again, if you're an investor, here's a reasonable case where you want to not have a bailout, and resources were not forthcoming, and they were not forthcoming for very long. So we think the Treasury put would be very much alive in the minds of investors. So we're trying to paint what the minds of investors look like in this case. Okay. So far, I think we've hopefully established that the Treasury put was alive, but now it's extinguished. Okay, and the seismic shock we need to examine that is the Detroit bankruptcy, which occurred in July of 2013. About $18 to $20 billion of liabilities were there. Federal assistance was sought by Mayor Dave Bing in talks with the Obama. Said he was in talks with the Obama administration, and in those talks, he did remind them that just a few years earlier, they had bailed out Chrysler and General Motors, so why not me? Well, we know the answer. He didn't get the bailout. There's no federal assistance was offered or in the offing for Detroit. The Obama administration came out and said no. In Congress, very quickly, in July, Lindsey Graham introduced some legislation prohibiting the federal government from aiding financially strapped states and localities. Legislation failed, but only by 2 votes. Some other legislation was immediately offered, also in terms of pensions, liabilities, making sure the federal government was not responsible for those. There's an interesting development in Puerto Rico in some court case today where there may be some indication the federal government is responsible for these. So it's going back and forth. But certainly Morningstar in October of 2013 summarizes, to my way of thinking, what the state was in terms of Treasury assistance in general, that there wasn't going to be any. So the Treasury put was extinguished. Okay. Fifth part of our argument here then is that what happens after that put is extinguished? Default risk rises. And in some ways the paper is in this chart. Now this chart is a little defective because we really would like to show it with yields. And we had a little computational problem in doing that and manipulating the data. So what you see here are bond prices. But the story, I think, comes out nonetheless really clear. The important thing is the red vertical line here. This is the Detroit bankruptcy. Okay? To the left, basically, the width is reflecting the differences in bond prices between insured and uninsured bonds. To the right of the Detroit bankruptcy is the prices of the same bonds that are being traded there on out. And what you see is this widening that's occurring. That widening, to our way of thinking, is the extinguishing of the Treasury put. So we basically see that the Treasury put on the left-hand side of Detroit was about, the risk premium was about 256 basis points. It rose to 423 basis points, and then ultimately, toward the end of the year, about 600. And we've had some talks about the delay to bad news, actually in this room here yesterday, and this is reflected in that graph as well. Our argument then is that these data document that the Treasury puts about 350 basis points. If you want to compare it to a junk premium, at that time it's about 580 basis points. Okay, great. Policy implications. We're in Brookings, we're in Washington. We've got to have some policy implications, or my travel reimbursement won't be honored. Three quick ones. First one, the removal of the Treasury put basically is an increase of 350 basis points, which translates into an increase in the cost of capital for Puerto Rico of about 45%. Okay? Now, as a practicing financial economist, you got to have a supply and demand curve somewhere, and here it is. Cost of capital is on the vertical axis, bonds are on the horizontal axis. The point A is basically the situation before Detroit, when there's effectively a subsidy on the demand curve for bonds. After Detroit, basically that subsidy is reduced, the demand curve shifts leftward. Note that demand and supply curves are backwards here because we have cost of capital on the axis, not prices. Demand curve shifts backward to point B, and basically that vertical distance is the measure of the Treasury put. In terms of misallocation of capital, which is really kind of one of my big concerns here, all we need is a supply elasticity. That was hard to find in the literature. And if anybody knows about supply elasticities, I bet you there's some folks in the audience who do, and if you can give me a reference besides this one here, I would appreciate it. But with this supply elasticity, the removal of the Treasury put, the shift up in that demand curve would lead to about $15 billion of excess capital that was allocated to Puerto Rico. Whether or not that's large or small, we haven't really thought too much about, but that's the number we come up with in terms of a misallocation of capital. And it may be important because a number of other states are also in trouble. The ones here that are talked about all the time when you say in trouble, I think we all have the same group of states in mind. The Treasury put might affect these as well. Now, we haven't looked at the incremental investment and so on as to how the impact would be, but certainly the numbers could be quite huge. Okay, second policy implication. There's an alternative hypothesis that the excessive flow of debt to Puerto Rico was because investors were misinformed. The GAO just came out with a really nice study, really thorough in terms of documentation, but to my way of thinking came to the wrong conclusion because they sort of favor this alternative hypothesis of misinformation, and hence their policy recommendations are more information, improved reporting, and so on. I just don't think that's true. The data from Detroit, the big change in the prices of debt in Puerto Rico don't suggest a misinformation hypothesis, but a Treasury put hypothesis. Okay, third one and last slide is how do we extinguish this Treasury put on a sustainable basis? Detroit did it temporarily, but is it going to come back? Well, we have this bailout history that we've noted above. To me, it's kind of bleak. Let's look at the Euro crisis. Euro was created under the Maastricht Treaty, and the Maastricht Treaty has a specific no bailout clause. It is no ambiguity. Chancellor Kohl for Germany, as the euro was being adopted, made several very prominent statements, no bailout. Yet we had to bail out. So the question is, how do we sort that out? And I leave you with, I'm not sure exactly what to do with respect to that. I think it's an ongoing problem. I've been assured that my discussant is a very knowledgeable person. I'm sorry to say his first name is not Alexander. And as far as I can tell, he has no Greek heritage, so I think the problem may still persist. But thank you very much.
Well, thank you very much for inviting me to this conference. I guess I have been introduced as an expert on bailouts. Hopefully that's partial. The book I wrote on this subject, which is now 15 years old, was actually entitled Bailouts or Bail-ins, ? So I hope I have some expertise on the restructuring side as well. Certainly, when I was added to the Treasury team in 2015, and the Puerto Ricans Googled me and found my book, they seemed to be much more concerned that I was Mr. Bail-in than that I was Mr. Bailout. But I do appreciate the opportunity to comment on this paper. It's a very interesting paper. I think the methodology pursued of pairing insured and uninsured bonds is very clever and very convincing. I think it should be extended to other bond pairs. And I think there's clear evidence presented in the paper that the municipal bond market didn't react to the deterioration in Puerto Rico's fundamentals by widening the risk premium on the GO bonds. It was especially striking that the bonds issued in 2011 and 2012 had such a low risk premium. It's fair to say that, perhaps the market couldn't anticipate the depth of Puerto Rico's troubles in 2003, 2004, 2005. But by 2011 and 2012, the fact that Puerto Rico had entered into a deep recession and, unlike the rest of America, had not recovered was actually quite clear. And I think the paper also convincingly shows that there is a change in how the market prices Puerto Rico around the time of Detroit's bankruptcy and the famous Barron's article that outlined the depths of Puerto Rico's trouble. The key question is whether this mispricing can all be attributed to a Treasury put or whether there are alternative explanations for this step change. But before I go into that discussion, I wanted to make a couple of quick comments on the paper. The first is that I think it would be, in some sense, helpful to do the really simple thing and compare the pricing on Puerto Rico's bonds at issuance with other benchmarks in the municipal bond world, AAA-rated municipalities. Benchmarking everything to the U.S. Treasury requires a little bit of mathematical gymnastics, and the straightforward spread over the top-rated municipalities might also be interesting. And particularly given the importance that Detroit plays in this study, I think looking at bond pairs for Detroit and subsequently bond pairs for Chicago, Cook County, the state of Illinois, might also yield interesting information. The second observation is that I think there perhaps should be a little bit more attention paid to Puerto Rico's institutional uniqueness. Puerto Rican bonds famously were triple tax exempt, which expands the investor base and potentially contributed to the mispricing. And Puerto Rico, in some deep sense, was never analogous to Detroit. Detroit is a municipality, an instrumentality of the state of Michigan, a Chapter 9 eligible entity. Puerto Rico, as a commonwealth, occupies a very unique position. And as a matter of fact, you could argue that this enhanced the expectations of a Treasury put because Puerto Rico, the Commonwealth, was not a Chapter 9 eligible entity, so the restructuring framework for Puerto Rico was not identified. And famously, Puerto Rico's municipalities and public entities also were not Chapter 9 eligible entities. So Puerto Rico was always in a little bit of a legal void, unlike Detroit. The question then is, why did Puerto Rican bonds pricing change so dramatically after Detroit, and can this fully be attributed to a Treasury put? I would note that Puerto Rico actually did issue one bond after 13, the 2014 GO, and it would have been interesting to see the risk premia on that bond. However, given that it was issued at a yield of 8% and at a discount to par, so its actual yield was more like 9, I'm not going to quibble. There is no question that the market had changed how it priced Puerto Rico by that time. The question is, in some sense, why? And was this the extinguishing of the Treasury put? Or was this simply what those of us who have worked in emerging markets typically call a wake-up call? That after a long period of very few defaults in the municipal bond market, there's a very big default, and that catalyzes a reassessment of risk globally, and particularly in those credits that look most like the city of Detroit, and who had a declining population and a declining economy and a declining tax base, Puerto Rico. So in the spirit of being a little bit skeptical that a Treasury put was universally expected, I want to first ask whether a Treasury put is as common in the general market as the author proposes, and then ask whether a Treasury put is as common an expectation in the municipal market as the author suggests. In the general market, there are actually many instances where the Treasury has not ridden to the rescue, and therefore the list presented in some sense is selective. In the world of emerging markets, Russia in 1998 was not bailed out. Argentina in 2001 was not bailed out. Even in the euro area crisis, Greece's bonds took one of the deepest haircuts seen amongst any sovereign issuance. And more recently, Ukraine's bonds were bailed in through a restructuring. In the world of large financial institutions, too big to fail, Lehman obviously, and as I'm sure the author would fully agree, wasn't bailed out. TARP was passed by Congress to create the authorization, but TARP's authority expired in 2010. The authority that allowed the U.S. to intervene in GM and Ford had, in a legal sense, disappeared. And if you look at how Dodd-Frank envisions addressing too big to fail institutions, the envisioned resolution mechanism is the conversion of holding company bonds into equity, not a straightforward bailout. Then in the municipal market, there, as to my knowledge, has not been a federal bailout since 1975, while there have been many intervening instances where municipalities had been allowed to fall into bankruptcy. More importantly, at least from the perspective of those of us working in Treasury at the time, the 1975 bailout of New York was authorized by specific congressional legislation. And while the Treasury has standing authority to contribute to the IMF and through the IMF to provide a bailout, the Treasury does not have a municipal bailout facility, nor any obvious legal authority that would authorize the provision of a long-term loan to Puerto Rico. So in some sense, the Treasury put was actually a congressional put. It required an assumption that Congress would step in and be willing to provide a guarantee, which certainly struck those of us at the Treasury at the time as somewhat unrealistic. Third observation, Puerto Rico's debt is not homogeneous, and the pricing discussed here is the pricing on Puerto Rico's general obligation bond, or its constitutional debt. There is an alternative theory for the mispricing, which is that in some sense the investors in the general obligation bonds expected to be prioritized relative to the rest of Puerto Rico's debt stack. This too could contribute to mispricing in the market. GOs are only, let's say, a quarter to a third of Puerto Rico's aggregate debt. They're a little higher fraction of its tax-supported debt. And in that sense, part of the expectation embedded in the market's pricing could have been that GOs would have been preferred relative to other structures, and therefore the market was looking too narrowly at the tax coverage of GOs relative to the taxing authority of the general fund, just as it was looking too narrowly at the sales tax bases of the sales tax supported bonds, COFINA, and looking too narrowly at the highway authority's gasoline tax, and failing to sum up and add up and recognize that the ensemble of the debt was untenable. In that sense, the failure of the general obligation bond pricing to respond to the creation of the COFINA structure back in 2006 and 2007, which pulled sales tax out of the general fund into a specific pledge, may prove to be the biggest mispricing of all. Policy conclusions. Well, if there was any concerns about a Treasury put, I certainly think Promesa has put them to rest. But I would also note that I would bet that almost no one can identify with confidence Puerto Rico's operating deficit for its tax-supported debt over time. I certainly can't, and I spent a lot of time on the issue. The oversight board's continually using a shifting definition of what constitutes the general government or the tax-supported government, and consistent time series data simply doesn't exist. So in that sense, I still think there is low-hanging fruit from improved information. Thank you.
All right, we have time for questions. I see Tracy Gordon.
Hi, Tracy Gordon, Urban Institute, and I was at the Council of Economic Advisors during some of the fun times with Puerto Rico. I just wanted to say, I think that identifying the counterfactual here is really difficult. The fact that Puerto Rico was able to access capital markets in March of 2014, even at very high interest rates, given the Barron's article and what was becoming available information-wise, was really striking to me. The offering statement was just a barn burner, in my opinion. It basically said in bold capital letters, "We might not pay you back," which I had never seen in an offering statement before. So I think that to the extent, and I take Brad's point completely, that it really was a congressional put, to the extent that the administration was involved, there was sort of there was ambiguity, and I'm not sure how much of it was deliberate. But the fact that to say that the administration was not involved in Detroit, I think is not right. The administration, had something like half a dozen cabinet secretaries on the ground working with the philanthropy community, which did not exist in Puerto Rico, and trying to come up with a solution. So I think that the federal government was involved, and that there were investors who perhaps, because of sort of a greater fool theory, like to perpetuate the idea that there could be a put. And in fact, the fact that the IRS did not rule on the creditability of the Section 154 excise tax. So I would encourage the authors to think about some of these sort of behavioral explanations and counterfactuals and what would have happened in the absence of some of these information reveals.
Let me just thank you. You're saying that the government was involved in Detroit, Puerto Rico. I'm sorry, I just wanted to make sure I got the fact right.
Yeah, there's a if you go to Obama White House Archive, .org, there's a report. Obviously the White House writes these reports after the fact and says this was a tremendous success, but it does have helpful sort of enumerations of actions that the administration took in Detroit. And for that matter, there's a similar report for Baltimore. So, you know, I hear you that it wasn't a new tax credit, it wasn't a line of credit, it wasn't a grant, but there were actions and people showing up in a way that they did not necessarily show up in, say, you know, Central Falls, Rhode Island.
Very good. Yeah, I would say in general, there's a number of things that we need to look at in terms of detail, but for example, again, apropos my dinner conversation about Mexico, those funds did come from the Treasury. There was a special fund. So we need to look at some of the specifics, apropos your point and Brad's point as well. Thank you. You want to call, please?
I see Bill Glaskell.
Thank you. I'm Bill Glaskell from Volcker Alliance. They were both fascinating presentations. I covered the Puerto Rico story at Bloomberg with great disbelief as it unfolded. All of the bailouts that Robert referred to involved systemic risk, going back to New York, which because the international banks had a lot of New York paper. Not for nothing, Puerto Rico didn't seem to represent a systemic risk. The holdings were very widely dispersed. There wasn't a single Puerto Rico holder that was going to bring the world down, which might have been the case with Lehman. The other thing is Puerto Rico, in some ways, was a Ponzi scheme. It wasn't operated by one person, by a Madoff or by one of the other classic Ponzi operators, but Puerto Rico was borrowing from the market to provide above market returns to its creditors over and over and over again. It ran out of individual investors, so it went one level up to mutual fund investors, who were one step removed from the individual market. Having run out of mutual funds, when the last Oppenheimer dollar went into the tank, it then went to the hedge funds, which were pretty much the lenders of last resort in this case. And then it blew up, much as Madoff's did when it kept going up and up and up the food chain. And I think that's something that needs to be studied further, perhaps to prevent it, and something that investors really didn't appreciate. When that last toxic issue was, and Tracy's quite right, I never saw an official statement that said, this is a toxic bond. Don't buy this. If you buy this bond, there's a very good chance you're going to lose everything. But the yield on it was so great that the hedge funds would say, well, we're just going to put 2% of our assets into this, and if we lose, we lose.
Yeah, I would say certainly looking at some of the bailouts that I listed, is well put. But Mexico, is Mexico systemic? Lockheed, Chrysler, some of them I don't know. So, but it's a good point, and we should make a differentiation between those two.
Just to answer very briefly, Chrysler was a systemic risk in the sense that it was going to put a lot of people out of work.
But under that criteria,
right.
Everything's a
I know,
systemic risk.
but people who vote. Mexico was certainly a risk to the international banks.
Mm-hmm. Yeah, I would say international banks are big banks, and they probably can sustain some of these shocks, perhaps well too. But the point's well taken to maybe be a little more careful about the things that we list, as with Tracy's point.
Hi, George Friedlander, Court Street Group. Building a little bit on Bill's excellent point of Ponzi scheme, and having watched some of the institutions that went through the thinking on this, especially pre-hedge fund, I would call it Ponzi plus, in the sense that there was this remarkable expectation among a handful of funds, and I would include the ones, I won't mention names myself, but there was a remarkable expectation that I could keep this thing alive by continuing to invest in it. And then when it got to the hedge fund level, it was, well, the yields are so high that even if I only get a partial bailout, my total return is going to be fine. And that, yeah, maybe Detroit and the Treasury played a role in that, but there was this incredible expectation among institutions that they would be okay on a total return basis if what they paid for it was just low enough And also they were trying to protect the assets they already had in it. So that was also a portion of their total return thinking. Well, if I've already got $3 billion in here and I buy another $1 billion, maybe I keep the price on that first $3 billion from flopping too much more. So that goes into my total return analysis.
Point taken. I think what you want me to do is to look at the composition of the holders of Puerto Rican bonds and whether or not the scenario you paint would be feasible. So that point's taken as well. Thank you.
Yeah. I mean, we at the Treasury certainly were paying attention to the question of whether there was systemic risk. The obvious loci of systemic risk would have been the bond insurers, who had a lot of exposure to Puerto Rico. And our assessment was that they were able to withstand those risks. We also noted the concentration in a couple of mutual funds. And given that those mutual funds had such a large concentrated position that they had very explicitly maintained when much of the market had lightened up on Puerto Rico after Detroit, it certainly seemed that they had every reason to anticipate, given the pricing, some form of restructuring. But to be clear, in these events in Detroit and in Puerto Rico, the federal government was very involved. Most notably, we were involved in the creation of a framework that allowed a legal process to restructure the bonds. I think the key question for the Treasury argument is why in a market where, except for Puerto Rico, there is a backstop called Chapter 9 that allows restructuring, a put is still so prevalent.
I'm gonna take the last word, and I'm gonna say thank you to the author and to the discussant for leading a great discussion.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.